Hello, everyone. Welcome to CAPIS's monthly research briefing. I'm Ed O'Dowd. This is part of a series that we have every month for our clients where we bring independent research content to you. Today, we have a familiar firm joining us, Markets Policy Partners. What they do is kind of look at macroeconomics, political policy, kind of the intersection of the two, and how it could affect markets going forward. Obviously, looking at the political environment and economics, they're very important, and I think timely, given a lot of the flux that we've had, in recent months with different things going on. So we're really happy to have them here today. If you're a returning client, welcome back. If you're brand new to the call, we always have some newcomers on. Thanks for joining us. We hope it's informative. I know it will be. I know these guys well, and it's always a good new, fresh perspective. Markets Policy Partners is located in Washington, D.C. Both the gentlemen there have a background in kind of being wired in with the political scene there, so they bring some timely insights. So, John, welcome.
Many thanks, Ed. We really appreciate it. Always the introduction and being able to jump on a call with CAPIS clients and yourselves. Really, always something we look forward to. And certainly, this is a hot summer for macro. Macro's back.
Yes.
And but obviously, everything comes with that caveat of a degree of unpredictability that maybe we had we could all sort of foresee coming with this new administration. So, the
Certainly.
tails are always a little bit fatter, but we'll continue to call it like we see it and let you know where we stand on these. But yeah, it's no shortage of topics. We'll kick it off with the tariff front, and I'm going to throw it to my colleague Brendan Walsh to go over our view on tariffs, which is essentially trying not to get sucked into the headline chasing and try to see a little bit further into the horizon as to where we think these are actually going to go.
Excited to hear it. Yeah, we're looking forward to this. Thanks, John.
Yeah. So kind of the most important view that we've kind of always had from the Trump administration, and it was just kind of paying attention to the election. The tariffs are a big part of how he views the global economy and America's role in it. So we're going to go through negotiations and things like that. And, the first announcement of, what we're going to charge, it probably isn't where it ends up. But I do think that, pretty much every country, unless a few are willing to go totally to zero in terms of what they tariff us at, we will have some sort of tariffs. So the new announcement is where the new kind of date is August 1st. So with Mexico and the European Union right now, assuming no new deals get done in the next 2 weeks, it'll be a 30% tariff on all imported goods from both Mexico and European Union. Canada is going to be at 35%. Pretty much every other country, the new reciprocal tariff rate will be in the 20 to 40%. We've made a little more progress with South Korea, South Africa. Japan, it seemed like we were making a little progress, and then we hit a stumbling block. So you're looking at in the say 30 to 40% tariff rates. A new one is a 50% tariff on all copper imports, and that's specifically with the hope of reinvigorating our manufacturing sector here. With Canada and Mexico, it is important to know that the current trade deal that we have with them runs out early next week. I mean, next year. So these kind of first negotiations with both those countries are very much in the view of the longer term negotiations that we have. I believe we signed that about 6 years ago. So that comes up in 2026. So we'll see kind of where that stands. The big outlier is China. China has a little more to kind of push back on us. I think in the last one we talked about rare earths. I think a lot of the world found out that they're a little more important than we realized. So those negotiations are still very much ongoing. With on our front, we make semiconductor chips, and we kind of limited them. We're kind of loosening that. The word is that President Trump really would like a sit down face to face with President Xi. So I think the negotiations on that front will be trying to create a situation where the two can kind of come together, and maybe Trump can have his kind of Nixon to China moment and hash out a deal man to man with President Xi. But that's not going to happen in the next 2 weeks. John, you spent a lot of time in China. How do you see China kind of viewing these negotiations going?
Yeah, I think that from the Chinese perspective right now, they feel like it certainly seems like they feel like they're in a pretty good position. You can see that from the communications, the foreign ministry, and so forth. They're always quick to point out that the White House has connected with them, asking them for meetings. I think the rare earth, they knew what kind of cards they were holding with rare earth and critical minerals, and so the application of that leverage, which has it's been something that we've been focused on. It's clearly a big deal for U.S. manufacturing, and this isn't just semiconductors and other consumer electronics. It's defense and really critical weapon systems and so forth. So this is a national security issue.
Yeah, exactly.
So the Chinese don't appear to be in a big rush, and you see this little drip of concessions, right? The last one was the AI chips from NVIDIA, able to all of a sudden those are able to to go to China again, and so I think the Chinese, by playing kind of coy and a little bit of maybe a rope-a-dope strategy, where they they concede, okay, we'll open up our licensing for critical minerals, but when the Chinese say we're going to open up our licensing, that doesn't mean that actually there is real legitimate follow through on some of these. I think that they feel like they're in a strong position. They feel like they have a winning hand. They feel like Trump is kind of the sort of thirsty one here for the deal, and they're gonna see how many concessions they can get out of him, particularly on that tech and chips trade. In the meantime, so I certainly wouldn't be surprised if down the road, later this year, you're hearing the Chinese, making more constructive noises about the meeting between Xi and Trump. But I don't think it's something that they're rushing into by any stretch of the imagination. And kind of the longer that they wait, they think that their negotiating position probably gets better, especially if you're in a situation later in the year where, as it's where if tariffs, where exactly they kind of shake out after this August 1st, it's probably not going to be kind of the high ebb of where we are looking at right now, but they're still going to be higher than they were, and if that feeds through into an economic situation that's a little bit subpar in the U.S., where you don't have, you get a few points off growth, half a point off growth or whatever it is, and you get sticky to high inflation, and you have the Fed, and we'll talk obviously a lot more about the Fed, and you have the Fed unable to get comfortable with an easing cycle, then you can see how the Trump administration would be even more eager to get that big deal with China, and so the basically giving in more ground, particularly on that tech transfer side, which obviously the NVIDIAs of the world really want, and the stock market likes. And so, it's I think something that be a back half of the year story for that engagement to maybe get some more uptake in Beijing.
Yeah, totally agree on that front. And obviously, these kind of things have implications on our global economy, which has implications on the Federal Reserve. So there's been a lot of headlines, but I think we'll start first where the Fed stands. And from really there isn't a huge amount of outliers on the FOMC. I think most are very content to kind of sit and wait. The data kind of continues to come in stronger than expected, while also the inflation numbers aren't as scary as maybe some thought could have happened as the tariffs started to take hold. The CPI number that we got this week, which was for July, did show some indications that the tariff rates on certain items are being passed on to consumer. Nothing massively troubling. It's not like it was up 5%, but there was indications on that front. The PPI, which got a lot of headlines, because it came in lower, but the PPI is the producer price index, and it's only what we make here. So imported goods are not included in the PPI. So it's not necessarily a great indicator to show, tariff pass-throughs. But it's all stuff that the Fed, takes into consideration. And, from the Chair Powell to, the other kind of important members, I think the consensus view right now is to sit and wait. John, we were talking about it early. So right now, the futures market is pricing in two rate cuts.
Yeah, that's kind of the central, that's the most likely base case, according to Fed Fund Futures, 2 rate cuts by the end of the year. But, with considerable odds given on either side of it, I think the skew is now for less. It's sort of 2 or 1 rather than 3, and rather than 2 or 3 is more likely. But, I think that our house view has been taking the under on that. We're more like 0 to 1, sneak one in kind of later in the year. It's, I don't think the White House is necessarily helping their case, piling pressure on Powell. We'll talk obviously a little bit more about that and Fed independence and, whether we think Powell gets fired. But yeah, it's a situation in which, looking across the, from dollar weakness to the sort of, the nervousness in the bond market, equities at the highs, and then all the economic considerations that you put out there, Brendan. Nothing, no necessarily red flags on the inflation front, but question marks about, is there more to come? Is there, chapters yet to be written on the feed through of tariffs into prices? One would suspect probably, yeah. And growth, looks to be fair to middling.
And that's the kind of point on the growth. We got retail sales today, and there was, somewhat fears that, the consumer is kind of tapped out, but, it keeps chugging along, and the U.S. economy, obviously the housing sector is not doing great, but the rest of the economy is doing, pretty well, and doesn't scream, oh, you have to, slash rates to save this thing. So I think that's where the Fed is at. But a lot of the pressure from the administration stems from the housing market. The current head of the FHFA, is very active on Twitter and the news, calling for Powell's firing, and then we have to cut rates to save the housing market. That certainly lower rates would help the housing market, but it also is just one part of the economy, and the rest of the economy doesn't scream. We have to take rates down hundreds of basis points.
Yeah, the futures are looking at kind of 50-50 odds on September. Our house view has generally been that's going to be too high as we get through August's data, and the meeting in July later this month is unlikely to signal an upcoming, anything decisive about an upcoming rate cut, in our opinion. So we're thinking, it's possible that they could kind of sneak one in later in the sort of October, December timeframe, if there's additional clarity on economic conditions by then, and the tariff situation and so forth. But it would be, we think it would be unlikely that it would be a big campaign style cutting. It would be more of a tentative cut, and sort of back to a wait and see kind of posture, likely that they would, perhaps skip a meeting after the first cut and so forth, just because of the high degree of uncertainty, but also, the weak dollar. We're seeing we're seeing pressure on the currency. There's, sort of the express to, implied weak dollar policy of the Trump administration. It's hard to like the dollar, right? And that's sort of that's a feature, not a bug, of this White House policy. So, um, that's a place where, the Fed isn't seeing necessarily imported inflation coming on the back of that. Usually that feeds through a weaker dollar, means high energy prices, and energy prices aren't high, but neither are they low, right? And that was sort of supposed to be the big decisive factor of Trump's disinflationary push, was supposed to be energy prices, going through the floor. The Middle East is, has been persistently and as usual, sort of stubbornly chaotic, and creating a geopolitical uncertainty under oil. OPEC has been been very proactive,
Yeah,
and
very proactive.
yeah, and global demand, global economic demand has been okay, not great. And so, the downside, in oil prices, I think, really does, all else being equal, one might expect them to be lower from here, but, sort of the combination of weak dollar and geostrategic uncertainties around it, I think, are keeping these prices elevated in the face of some pretty, meaningful headwinds.
And on the firing of Powell, there's a lot of different things we can discuss. We'll talk about the legality of it, but I think first and foremost, it's important to understand that the chairman of the Federal Reserve only has one vote, and it is a committee. So even if you did fire Powell, that doesn't necessarily guarantee that the rest of the members would follow whoever they put in charge to, massively slash rates. In fact, it probably would have the exact opposite effect upon those members, who, we have a mix of Republicans and Democrats on it, but I think their commitment to Fed independence would outweigh, any political ties. So you could have a committee that really, digs their heels in terms of keeping rates where they are. Then secondary, or maybe even before, if you did fire the chairman of the Federal Reserve, the bond market is allowed to react as it wants, and that might be a very negative reaction, certainly initially. What do you think, John?
Oh yeah, I mean, I think we saw the flickers of that yesterday, right? You see the long bond isn't doing great, and the break evens, longer dated inflation break evens are uncomfortably higher and trending. And they got a pop. The dollar also took a stumble when those headlines hit, and so it's easy to see, if it were actually to materialize, those trends would, presumably have, kick in, and then the gears would catch for another down leg in the dollar, for additional upside pressure on tips break evens and on longer dated treasury yields. That's not what, the equity market would want to see, I don't think. And so, what was yesterday? Was it like a serious attempt that was thwarted by the negative market reaction? Was it just sort of a trial balloon, or what, just to try to recapture the news cycle, distract from other elements in the news, which we don't need to get into? But there are a lot of reasons why they might have, and just to heap pressure and make Powell uncomfortable. And it's clearly something that Trump is itching to do. And so just to sort of scratch that itch a little bit, maybe yesterday, a variety of different factors. But at the end of the day, the market reaction sure looks like it, to the extent it was a trial balloon. The trial balloon was met with some pretty adverse financial market reaction, and you can certainly extrapolate that into, those trends if you actually went through with it. And then, the question of, is it really like a good move? And Trump's political instincts, aren't always easy to predict or foretell. But it's later in the year, if there is again, like a subpar economic outcome, having a scapegoat is awfully convenient.
Yeah.
Right? Like being able to continually beat up on Fed Chair Powell and blame him for things that aren't going, the way that you want them to go, whether it's sticky inflation, whether it's, slightly tepid growth, or whether it's both. If you've got a Fed chair that you have pilloried publicly, he's going to be a fantastically convenient whipping boy for all that. If you put in your guy and things continue to go wrong, then who are you going to blame? So it's,
And
I
Powell's
think
term
there's,
comes, yeah, and Powell's term is over in, not a few months, but, early next year. So you do have that opportunity to replace him down the road, but you could make it through the uncertain time with, as you say, a scapegoat. So,
but yeah, and the point that you make is like, even if you put in someone who was like a total flunky who
yep,
wanted to cut rates down to 1%, how do you get it past the committee?
yeah,
And
it won't
so
happen.
you get an adverse bond market reaction. You don't get the rate cuts you want, and you lose a very convenient scapegoat
Scapegoat,
to
yeah.
blame for,
Yeah.
bad outcomes. So, I think at the logic, and obviously logic gets defied all the time, but the logic points to, Fed Chair Powell staying in place and continuing to be the object of significant criticism and derision
Right.
by the White House, and a scapegoat for anything that is going to go wrong in the economy, to the extent it does in the back half
And
of
also, on a technical law, the president is allowed to fire the chair, but it has to be for just cause. They're kind of focusing on they're doing a $200 million renovation to the office. I've been in the office. It is fairly dated. I don't know if it's $200 million dated, but that's what they're focusing on. But from a legal standpoint, their problem is then they also then criticize publicly his decisions as Fed chair. So Powell would certainly, sue if he got fired. That would probably be spend the remainder of his time at the Fed within the courts. So you actually wouldn't even be able to fire him, and you'd have all the negative effects of it. Yeah.
Wouldn't it make sense to just wait till his term ends? I'm not
Yeah,
sure.
and that's what I'm almost positive will happen.
Yeah.
The president doesn't want to shoot himself in the foot if he doesn't have to, but it is kind of he does do a very good job of creating the scapegoat if he ever needs them. Yep. The big beautiful bill was passed for the most part, kind of as expected. Just from a technical standpoint, through the reconciliation process, we have this other process called rescission. They have 2 or 3 more bites at the apple. We're starting the process now to do some more cuts. I suppose you can add spending too, but the focus is obviously to do a few more cuts. But on this front, we're talking about $10 billion here, $10 billion there, not anything that would massively change the potential borrowing, over the next 5 to 10 years from the tax cuts. But from, for the most part, that's done, especially from the president's standpoint. He won't have to, get involved too much on this rescission process. So I think the focus of the administration right now will be tariffs almost entirely. Outside of this stable coin bill that's going through, which is having a lot more difficult time than one would have expected. A lot of that is because people keep throwing things in that they want to ride it. But we do think this stable coin bill will be passed, fairly soon. The issue kind of now is the House views themselves as being looked down upon by the Senate and just having to accept so the House wants to put in a few things. So that will take up a little time with the president, but I think the focus of the summer for the administration will be almost entirely on on tariffs and trade.
Yeah. And just a quick look overseas. You've mentioned China. China's growth is okay, and has been sort of chugging along at a slow pace. Not particularly exciting. The markets in China aren't particularly exciting. It's not President Xi is deriving his legitimacy, and he's a strongman leader, nationalist, and so forth. I think the excitement on China is going to be around the concessions that the Trump administration might be willing to give in the second half of the year to secure that meeting that they're looking for. And so, second half of the year, it's going to be interesting to see just how that might be a bullish time for we've been sort of chronically unimpressed with Chinese and chronically skeptical of any sort of stimulus related bounces in China. Chinese financial markets, stocks tend to like mean revert rather than trend. So but back half of this year with President Trump potentially making more and more concessions to China to get them back at the table, it's pretty clear that they're more likely to go carrot than stick on the Chinese because of the leverage that the Chinese have. It might be a good window to look at China and see if there's some value there. But we've always seen China as sort of a rental a market to rent rather than really own. Looking over, Europe has obviously gotten some the sort of less stagflationary dynamics. Obviously, they've been pummeled by the tariffs, but the expectation is that the Europeans that are being, and this is again, you can say that this is, you can quibble with the approach, but the pressure from the Trump administration has certainly been galvanizing for Europe in pretty important ways, and coming out with significant regional defense packages and so forth, and having the Germans loosening their fiscal constraints, which were I think a huge drag and frankly bad sportsmanship within the I mean, who's benefited the most from the euro? The euro is like the Deutschmark with a bunch of sandbags. It's like the Deutschmark is like a hot air balloon, and all the other currencies in the euro are a bunch of sandbags holding it down. And so the Germans have just been reaping enormous benefits from being in the euro and just shafting Southern Europe. And so loosening the fiscal purse strings really is the best way for them to make amends for that imbalance in their hollowing out essentially of manufacturing in the rest of the in the EU. So I think that there's something really positive, a positive story to tell. And the tariff situation will be the to the extent that it gets resolved in a more constructive way, like we expect, in general, most of the tariff negotiations to go. I think the outperformance in Europe is I think it's a really nice trend. It's something that has been overdue, and give credit where credit is due. President Trump knocking heads together on the continent has woken people up, as well as the massive conflict on the eastern border. So it's maybe it's a new era, and the European Central Bank has had the ability to cut rates in a way that the Fed hasn't, given the economic outcomes over there. So we continue like that. The yen is a mess, and we don't think that the Bank of Japan is going to be getting back into the rate hike business in a meaningful way to support the yen. They've got imported inflation for the first time, so that's an interesting one to watch. We're not particularly excited about Japanese markets, but if the yen can find its footing, and there's a significant and they get and they're able to capitalize on what has historically been a good relationship with Trump through these negotiations, then that might be something to watch. But if the yen can't get up off the floor, then it's going to be pretty tough for the Japanese story to make a lot of sense over the coming quarters.
Kind of the only final thing is, yeah, on regulation, the deregulation will continue. The big banks have been big winners. They kind of got everything that they hoped for in terms of, capital relief and kind of fixing some of the onerous parts of Dodd-Frank. Energy continues. So all that happens in the background. That doesn't need to go to Congress. As the new administration gets more entrenched within the various agencies, that'll continue. And that's probably the story for the next 3 months.
Yeah, let's if there are any questions, be happy to answer those the best we can. And
Yeah, absolutely. One question I had was, talking about Powell with the hesitancy by the Fed to be cutting rates at the rate that Trump would like them coming in at, is perhaps the Fed and Powell, the number one factor they're trying to control is inflation coming back to how horrible it was, say, 3 years ago. With the uncertainty that tariffs could have on inflation, and with a lack of certainty right now of how this is all going to play out and where the different rates that we're negotiating are going to be, wouldn't that be a factor that the Fed would kind of wait and see approach, say, hey, better to hold still amidst uncertainty on tariffs and how that will inflect inflation rather than just give you a cut right now? Do you think that's the number one factor that the Fed's considering and talking about?
100%. Their growth mandate is fine. The economy is not falling off a cliff. Their inflation mandate still is above their target. And you have this massive amount of uncertainty where you just don't know, how tariffs are going to play out in terms of the consumer prices. So there just isn't a huge reason as a central banker to take a risk. And because if you're wrong, inflation could get really out of control. If it turns out that, tariffs didn't get passed through, that the companies, ate it, then you can lower rates down the road should you need to. But yeah, you fulfilled your inflation mandate. So I think especially after COVID, the whole transitory thing, they're very sensitive to their to be viewed as inflation, not hawks, but fighters, that they take that part of their mandate very seriously.
Makes sense.
totally agree. Yeah, it's
sorry.
inflation expectations, I think, are something they're also, they don't
They watch
want to.
closely, yeah.
Yeah, there are surveys that show that Americans are worried about prices, and the tariffs. It breaks through in those headlines, and they understand that that has potential upside risk. So there's that's another factor as well.
And we all, as market participants, as consumers, as individuals, have adjusted, I believe, to this higher rate environment that we're in, that we haven't been in many, many years. And it's more the norm historically than perhaps the last 20 years or 15 years had been. Let me ask you this. And I had a conversation with a client about this. Like, don't you see it, or do you guys see it as bullish that the equity market has done as well as it's done amidst a climbing wall of interest rates? Isn't this kind of reserve gunpowder that when we finally do start cutting rates, that should be even more bullish for the stock market? Typically, when rates are going down, it helps equities. Like, we still have that firepower available for the equity markets that we haven't used yet. Like, isn't that a good thing to look forward to? What do you think?
Without a doubt. And we are in a unique situation. Because of COVID, we cut rates to zero, and then everyone refinanced. So the vast majority of consumers are not borrowing at current rates. They locked it in, and you don't need to take a mortgage out every week and things like that. So if we did then have to start lowering rates, you do have a huge amount of potential dry powder of people that would be interested in, I don't know, buying a car or taking out a loan, that they just don't need to do it now, but at the proper rate, they would be more than happy to do it.
I completely forget the stat, but I saw a stat the other day, and I don't remember it, of the percentage of Americans who completely own their home outright with no mortgage, and it's
and
quite
that's
high.
almost the entire baby boom generation.
Exactly.
And everybody else who owns a home or owned one in 2020, 21 refinanced. So they're at for 2-3%. Yeah.
And they don't want to sell because, hey, I'd
Right.
have to refi at this new rate unless you're sitting on a
Exactly.
ton of equity and you could
Which
trade
is a
down.
huge reason why the housing market is as stagnant as it is. You need a huge life event, or a life event where you got to move, or you won the lottery, you got a big raise, and you can afford to take on the bigger mortgage, or you don't need the mortgage, right?
Absolutely. Well, I don't see any other questions. I think if anything else pops up here, I think we're about good. If anybody has a question at all, put it into the chat or raise your hand and I will read it. You got these guys live, please ask away. But if not, I
And
think
also
we're good.
pass on, if questions come in the future, just email Ed and he'll get a hold of us. We're more than happy to answer.
Absolutely. And that's a good way to also, let me mention this, and I want to make this clear. For any of our clients or anyone new in the call, if you like what you're hearing from Markets Policy Partners and want to speak with them directly, maybe a personal relationship where they can kind of bill you or work something out with you, we can set that up. So contact your CAPIS sales rep, reach out to me, any of us here that you talk to at CAPIS, and we can get you in touch with Brendan and John, and they can, advise you and kind of as per your portfolio and your current situation.
And we have the daily emails and things like that, subscription services. So we're open to all types of relationships.
Oh, that's great to hear. Well, thank you so much, guys. Appreciate it. And thank you.
Rest of the summer.
Rest of the summer. Here we are in late July. We're still in the dog days, but before you know it, we'll be to Labor Day. And speaking of that, our next call is going to be in August. We're going to have Katie Stockton of Fair Lead Strategies. Believe Thursday, August 21st. I'm not 100% certain on the date, but we will be reaching out to you for sure. So we'll let you know. But appreciate everyone joining us today. Thank you so much, John and Brendan.
Thanks for having us.
Of course, always. I enjoy the
quarter.
talk. It goes so quick. You guys are really, this is a fun time.
Exactly.
Look forward to doing it again.
Okay.
All right. Thank you, everybody. Take care.